Hello, this is Japanese Economic Review Channel. Welcome to the executive briefing on Japan's machinery orders for May 2026. Today we'll explore a fascinating core divergence. While headline numbers suggest strong growth, they mask a sharp, temporary contraction in core private sector capital expenditure. Let's unpack what this means for the broader economic outlook. The May data presents a paradox. Total machinery orders surged by 9.5% month-over-month to 4.42 trillion yen, driven by massive utility investments. However, core private demand, a primary leading indicator for corporate capex, contracted by 12.4% to 962 billion yen. Meanwhile, the unfilled order backlog is rising towards 50 trillion yen, providing a crucial buffer. Breaking down the 4.42 trillion yen total, we see private demand soaring by 37.4% to 1.7 trillion yen, single-handedly driving headline growth. This masks broader macro headwinds. Foreign demand, public demand, and agency orders all contracted. The headline figure is essentially inflated by extreme anomalies within the private sector. To find the true capex signal, we must filter out extreme, lumpy investments. Electricity orders exploded by 342.9%, while shipbuilding plummeted by 80.5%. Stripping these out gives us the core private demand of 962 billion yen, representing a 12.4% contraction. This smoothed metric is much more reliable for assessing corporate capital expenditure trends. This 12.4% drop in core capex shouldn't be viewed in isolation. As the chart shows, this contraction is largely a snapback from the significant highs we saw in the first quarter of 2026. Rather than a structural collapse, the May data represents a return to the structural baseline, stabilizing after a period of elevated corporate investment. Manufacturing orders fell 14.9% to 437.2 billion yen. This broad weakness was driven by sharp pullbacks in Infocom's machinery, down 23.6%, and general-purpose machinery. However, there are pockets of resilience. Fundamental materials like non-ferrous metals and chemicals captured baseline investment, growing by 19.5% and 19.2% respectively. Core non-manufacturing contracted by 9.3% to 516.9 billion yen. Severe pullbacks occurred in real estate, plunging 69.3% following a massive April surge, and transport, down 23.3%. These contractions in traditional service sectors are entirely masked in the broader non-manufacturing data by the colossal 342.9% mega orders in electricity. Moving beyond the private sector, we observe synchronized softening across external and public channels. Foreign demand slipped 4.4% due to weak heavy electrical machinery, while public demand fell 5.0% on defense and transport pullbacks. Agency orders also decreased 5.8%. It is a consistent, mild deceleration across these macro channels. Crucially, the industrial base is highly protected. The unfilled order backlog has reached a historical high of approximately 50 trillion yen. This acts as a massive production reservoir, representing roughly 15 months of steady output. Therefore, while leading indicators dipped in May, coincident indicators like sales and production will remain highly stable. In conclusion, while we face immediate headwinds like a broad-based manufacturing